All right, so Chapter 2, Tax Compliance, the IRS, and Tax Authorities. Again, this is kind of an introductory chapter because you need to know what's required by the IRS, and you also have to understand the whole federal tax structure. So that's what this chapter is about. All right, so the first thing we talk about is taxpayer filing requirements. Not all taxpayers have to file a tax return, only if you make over a certain threshold. And so if you look at some of the requirements, we don't talk much about corporations, but all corporations must file regardless of taxable income. Estates and trusts, that's not important to know. Individuals, that's what we're talking about in this class. Filing is determined by the taxpayer's filing status. For example, single, married filing jointly, married filing separately, etc. Age. If you're a certain age, you get a little extra. And of course, gross income is the biggie. But all three are certainly taken into consideration. So, for example, and I'm not going to go through every one of these, certainly you can read as well as I can, but note that, for example, if you're single, you're not required to file a tax return unless your income is $10,300 or greater. Why is that? Well, that's because you have this thing called a standard deduction that every taxpayer gets, as well as a $4,000 personal exemption. So, if you made, let's say, $9,000, you would get these deductions and personal exemptions anyway, so you wouldn't owe any tax. As a matter of fact, you would probably get money back. So there's no reason to file a return. Does that mean you shouldn't? Let's say you do make $9,000. Should you not file a tax return? Well, the least you should do is probably prepare a tax return and see if you get a refund. And if so, certainly you would file a tax return to get that refund, but there's no requirement that you have to file a tax return if you make less than, for single individuals, $10,300. All right, going to the next one, single, 65 or older. Note here that the federal government gives old people, elderly people, 65 or older, an additional $1,550 additional deduction on top of the $6,300 standard deduction and the $4,000 personal exemption. If you don't quite understand what those concepts mean, again, we're going to go over these ad nauseum, so by the time this course is over, you will definitely know what those mean. Married filing jointly. We'll notice that the standard deduction is twice as much as a single person, and the $9,000 personal exemption is twice as much because you have two personal exemptions now. Note that if you're married filing jointly and one spouse is 65 or older, you get an additional $1,250. Now note there's a difference there between single 65 or older. It's $300 less. Why do they do that? Again, sometimes in these rules, in the code, in the regulations, you ask yourself why the IRS did such and such. Sometimes there's not always an easy answer. Why do they give a single 65 or older $300 more? Hey, if you're 65 or older and single, you probably need $300 more. So, is that the reason why? I have no clue. But we can only surmise. Both spouses, married filing jointly with both spouses 65 or older, they get twice that much additional deductions, plus the $12,600 standard and $8,000 personal, and on and on and on and on and on. So anyway, that's the thresholds. Tax return due date for individuals, the 15th of the fourth month, that would be April 15th, of the month following the end of the tax year. And so here we are in 2016. The book we're studying deals with 2015 taxes. And so on April 15th, 2016, if you make over those threshold amounts in gross income, you have to file your tax return on or before that April 15th date. Why? Well, it says here usually taxpayers, individual taxpayers are usually on a calendar year. You probably know from financial accounting that you can have different types of accounting years. Well, that same concept is true in tax. Most individuals are required to file based upon a calendar year tax year. And so their tax year runs from January 1st through December 31st of that year. And because of that, you got to file your tax return on April 15th of the following year. Are there exceptions? Yeah, you can file for an automatic extension of up to 6 months, or 6 months, not up to 6 months. Well, I guess technically up to 6 months, because if you file for the automatic extension by April 15th, you get up to October 15th to file, but you could certainly file sooner. You just have to file by October 15th. Corporations, 15th day of the third month following the end of the tax year. Kind of unusual there in that you've got a month's less time. Of course, corporations, the good ones are, or semi-good ones even, are pretty much on top of this stuff. So, you know, it shouldn't take them that long to prepare a tax return, because, you know, they're updating stuff daily. What happens if the 15th of the fourth month falls on a Saturday, Sunday, or holiday? Well, that due date is extended to the next business day. And again, individuals and corporations are allowed to apply for an automatic 6-month extension as long as you do it by the due date. And you can do it electronically. So we have some examples here. Corporation XYZ has a tax year which ends on August 31st. Now, unlike individuals, corporations can have tax years that are different than calendar year. And so in this example, we've got a corporation which for some reason has a tax year ending August 31st. And so when is their tax return going to be due? Well, it's going to be due the 15th day of the third month following August 31. So September, October, and so the third month is November. So the 15th of November is going to be when they have to file either the return or file for an extension. And so if they did file an extension, when would the tax return be due? Well, let's see. November 15th is the third month. So let's see. Go from November 15, December, January, February, March, April, May. May 15th. You're not seeing this, but I'm using my fingers. Well, what happens if you don't file a tax return, or what happens if you file an erroneous tax return? What happens if you file a fraudulent tax return? What should happen then? Well, if you've studied business law, you may have dealt with this thing called the statute of limitations before. Why do we have statutes of limitations? What is that all about? Well, in tax, taxpayers want some certainty. They don't want the IRS to be able to come back on a tax return that was from 20 years ago, let's say. Let's say that the IRS had the ability to come back and audit a return from 20 years ago. That doesn't bring a whole lot of certainty. You'd have to store your returns for a long period of time. So this statute of limitation idea is to bring about some certainty. Once you reach this threshold date, beyond that date, the IRS can't come back and assess you for additional taxes. The other side of this, from the IRS viewpoint, I would say they would agree with all that. But what happens when what you do is pretty blatant, such as filing a fraudulent return or not filing a return? Should there be a statute of limitations? So we'll look at that. And so it's not uncommon to file incorrect amounts. Sometimes these amounts are reported are in the taxpayer's favor, but many times what happens is they're in the favor of the government, and the government wants you to pay them additional taxes. And so the statute of limitations is the time in which a taxpayer can file an amended return, or the IRS can assess a tax deficiency. What does assessment mean? It simply means that they put it on their books as the taxpayer owing a certain amount. The general rule, and understand what you're studying here when we're studying the Internal Revenue Code. Probably should have started with this in chapter 1, but this is a good little detour. Understand that you are, in essence, studying law. Well, I didn't want to become a lawyer. Why am I studying law? Well, that's what you do. That's what tax practitioners, tax specialists do. They study the tax law. They apply the tax law to a particular client's situation. Well, that sounds like the practice of law. It kind of is. It kind of is. It's, understand, there's this thing called unauthorized practice of law. You can't do certain things unless you're a licensed lawyer. But as long as you're limited to certain things in helping your client, advising your client on how to apply the tax law, that's perfectly legal. It's essentially the authorized practice of law. So this is very much what lawyers do. You're just limiting it to the application of the tax code and regulations and other tax authorities to your client's situation. And so what I'm getting at is that when you study law, usually what you're doing is you're studying certain topics, and within that topic there's a general rule, and there's usually one or more exceptions to the general rule. And so that's kind of a recurring theme that you'll hear over and over again. So let's get back on track. General rule for statute of limitations is that the taxpayer or the IRS has 3 years from the later of the date the tax return was actually filed or the tax return's original due date. Huh? So I'll give you some examples here. What happens if you've got a situation where you file a tax return, let's say in this year, on February 15, and there's an error in it. How long does the IRS or you have the right to file an amended return, or the IRS has the right to assess a tax deficiency, an additional tax deficiency in that case? Well, they have until, let's see, this would be, you would take the later of the date their tax return was actually filed, which was February 15th, or the tax return's original due date, which is April 15th. So the later of is April 15th. So you go 3 years from April 15th, 2016. So 17, 18, 19. You've got to file something by April 15th of 2019. What happens if you file on October 15th. You file an extension and you file October 15th. Well, there, the later of is the date the tax return was actually filed, so you'd have until, or the IRS would have until as well, until October 15th, 2019 to do something, either file an amended return if you're the taxpayer or assess a tax deficiency if you're the IRS. So that's how that works. So we have an example here. They file a 2011 federal tax return on September 6th. After receiving an extension to file their return by October 15, 2012. When does their statute of limitations end for their 2011 tax return? So it's going to be the later of the due date or actual filing the return. That would be September 6th. So you go 12, 13, 14, 15, September 6th, 2015. Well, you might ask yourself, well, why don't they get until October 15, 2012? And the answer is, well, this tax return was actually due April 15. Okay? So April 15th is the due date, not October 15, when you file an extension. All right, audits. Don't want to spend a lot of time on this, but do want to spend a little discussing audits. IRS audits are done in different ways. Usually when you think of an audit, you think of getting a letter from the IRS saying, hey, we're auditing your tax return for year such and such, and you got to bring all your documents in and prove that, you know, whatever, that you don't owe this amount, or usually they'll ask for specific items. There's usually a reason why they're auditing you. So, you know, that sort of scenario can be pretty scary. This is why tax professionals are hired to represent clients in audits. If you are a CPA, you can become authorized to practice before the IRS and represent clients in audits and other matters and get paid pretty good money. When I was doing this stuff, at the end I was charging like $300, $350 an hour. Well, you know, depending on the type of audit, you can make a substantial amount of money doing this stuff. I certainly did. So anyway, it's not all about the money. If you have a passion for doing this stuff, that's why you do it, not the money. Remember that. All right. So the audit is initiated by the IRS. It's because they believe that a tax return has a high probability of being incorrect. Now that's not always true because there's several types of audits, but at least for high income taxpayers, that's definitely true. They definitely look at certain things, especially high wage earners, they look for certain things in high wage earners' tax returns because there's a high probability of stuff being incorrect. They use computer programs to identify tax returns which might have an understated liability. Now, they're not interested in overstated liability. They're always interested in understated liability. I mean, that's always their big concern, is they're under collecting from the taxpayer. And again, this usually only applies to high-income individuals and other types of individuals and businesses that might deal in cash and all this stuff. But there's something called the DIF, Discriminant Function System, and this DIF system basically assigns a score to each tax return that represents the probability that the liability on the return is underreported. Again, that's about all you have to know about that. Now, in theory, all tax returns are audited at some level. At the lowest type of audit, you have this thing called document perfection. If you've ever dealt with having to file a return, you know that you get a W-2 from your employer, you get 1099s on things like interest income, things like that. And so they're getting, the IRS gets a copy of those W-2s and 1099s. And what they do is they, not only do they check for math errors, you know, plus and minus and times and division, but they also compare the documents you've submitted with documents that have been submitted by third parties on your behalf. And if you're, let's say you're missing a W-2 or a 1099, well, they're going to know about it because they're getting it from the third party. And they're going to contact you and say, hey, we changed your tax liability because you left off this 1099. And so that's the information matching program. You have different types of audits. Most common is this thing called the correspondence audit or correspondence examination. This is done by mail. Sometimes if they're having you prove something, let's say you're a low wage earner and you're trying to qualify for this thing called the earned income credit. In order to be or qualify for the earned income credit, you have to have dependents. Let's say that they send you a correspondence concerning proving that you have these dependents. So there might be some additional proof that you have to send them. If it's just a math error or you left off a 1099, they would just say, hey, we're adjusting your liability because of whatever. Office examinations are the second most common. That's the letter that says you are required to come in at a certain date, certain time, with certain documentation. This is obviously broader in scope. They're going to dig through your stuff in this case. This is why you keep good documentation. Field examinations are the least common type. Again, if you're representing, let's say, a self-employed individual who has a business or a corporation or something like that, you want to get in the middle of that to protect your client from the get-go. Sometimes you don't have that choice, since sometimes the taxpayers don't come to you until after they've said too much. But at some point, if you're a tax practitioner, you want to get in the middle of this between the taxpayer and the IRS. One of the things you want to do is not to have a field examination. Best thing to do there is to try to get your client to bring everything to you and have the IRS come to your office. This can take a while. These types of examinations can take upwards of a year or even longer. Well, what happens if you are subject to an audit, usually the office audit or the field examination? What happens if the IRS does their audit and comes back with a report that indicates that they believe you owe additional amounts of taxes? So that's called an additional assessment. What happens if you don't agree with it? Well, you do have some recourse. And so the first thing you will get, if you're the taxpayer, is you'll get what's called a 30-day letter. And it's called the 30-day letter because you have 30 days to do something. Certainly, if you agree with the proposed adjustment, you just sign the 30-day letter and send it back to them, and done deal. Well, what if you don't agree? Well, you can request I want to say a hearing, but it's not really a hearing. It's just really more of a conference. Yeah, it's a conference with a representative from the IRS's appeals office. And, well, why would you want that? Well, understand, the people doing the original audit usually are fairly low-level employees. Okay? The appeals division, the people in the appeals division, first of all, it gives a fresh set of eyes to the situation. The appeals officer. The appeals officers are at a higher level than those who did the audit. And so they have a higher level of expertise. They also have more settling power. In other words, they have some flexibility. Usually this flexibility is to settle is based upon what's called hazards of litigation. If the topic is such that it's unclear, if you brought it to tax court and litigated, the IRS might lose. They can take that kind of stuff into consideration when considering settling for less than the amount of the proposed additional assessment. So this is another area where you as a tax practitioner can get involved and can be an immense help to your client, save them thousands and thousands of dollars. They will be grateful to you and will send you lots of referrals, or some referrals anyway. Well, what if you don't agree with the proposed adjustment even after the appeals conference? Sometimes sometimes the appeals people aren't too flexible either. Well, and this is true, this next part is true whether you get an appeals conference or if you just ignore the 30-day letter. Because you can just ignore the 30-day letter. Either way, what you're going to get is this thing called a 90-day letter. Officially, it's known as the statutory notice of deficiency. It's called 90-day letter because the letter says you've got 90 days to either agree to this, pay it, or file suit in tax court or some other jurisdiction. Now, the tax court is the usual jurisdictions where you would file this suit if you don't agree with the amount owed, the amount of the proposed deficiency. You could, though, if you pay the tax and file a claim with the IRS, you could go to a couple of other types of jurisdictions. You can file suit if you pay the tax and file your claim, and the IRS will deny the claim, and then once they deny the claim, you can file your suit either in district court or the U.S. Court of Federal Claims. Well, what if the proposed assessment is several thousands of dollars and you just don't have it? Well, best thing to do is to file in tax court. The reason why is because it doesn't require prepayment. It doesn't also require you to file a claim for a refund on that payment. So the tax court is the preferred and most, I would say, appropriate forum for filing a tax case. These other courts are courts of general jurisdiction. They hear anything from well, especially in the federal district court, they hear federal drug cases. They hear, patent cases. They hear all kinds of, well, not patent cases, but other federal matters because there's a special court for patents. And so they hear a lot of different types of cases. They're generalists. They're not tax experts. Why would you want to file in district court? Well, what if the matter has some emotional issues involved? I can't imagine a tax issue being emotional, but let's say it is. There's an emotional component. Well, you might want to get a jury involved. It's the only forum where you can ask for a jury to hear the case. Court of Federal Claims, tax court, the judge is the judge and the jury. So it's what we call a bench trial. You don't have a jury deciding the case, you have a judge deciding the case. But if it's highly technical, you want to go with tax court, more than likely, unless you're just trying to confuse jurors, in which case you would go to district court. Well, what happens if you don't go to, well, let's say you go to a certain court, let's say it's tax court, and you don't like your decision or the decision of the court. What do you do then? Well, just like all other cases, you can appeal the decision of either the tax court, the district court, or the U.S. Court of Federal Claims. And so the question is, which U.S. Court of Appeals do I appeal to? Well, it depends on where you live. And this is part of the consideration in deciding where to file your case in the lower court. You might get a favorable judgment, let's say, if you file in U.S. tax court or U.S. district court. If you know that there's a U.S. Court of Appeals case out there, for example, since we're on the West Coast, the 9th Judicial District. The 9th Judicial District, if you look at the map on page 9, covers Oregon, Washington, Idaho, Montana, California, Nevada, Arizona. And so if you live in one of those states, then you know that if there's a 9th Circuit case out there that's favorable to you, in case you do lose at the lower court, you can appeal to the 9th Circuit. And since you know that there's this precedential case, not presidential, but precedential, meaning there's precedent, you would want to file there. Well, what if there's a U.S. Court of Appeals, Circuit Court of Appeals case out there that's in your favor? Well, then, assuming you have the money to pay up front, and then you want to file in the U.S. Court of Federal Claims. Well, what if there's no case in your circuit, but you don't like the decision? Well, you'd still have to file an appeal in the U.S. Circuit Court of Appeals that covers your state of residence. And then if you didn't like their decision, if you lost there, you would have to file what's called a writ of certiorari, also known as filing a writ of cert, or filing cert to the U.S. Supreme Court. That's true of the U.S. Circuit Court of Appeals for the Federal Circuit also. Your only recourse at that point is to file writ of cert with U.S. Supreme Court. Note that many times, the U.S. Supreme Court will deny cert, meaning they're not going to hear the case. At that point, then you have no other options, and you're stuck with your decision, with the decision of whatever court heard your case. But, and especially for tax cases, Supreme Court just doesn't take a lot of tax cases. It has to be something that's fairly novel, or has to be something where there's a conflict between the various courts of appeals in certain circuits. Let's say that the Fifth Circuit decided a particular issue one way, and the Ninth Circuit decided the issue just the opposite way. I mean, that happens quite often. In that case, if it's a fairly substantial issue, then the IRS the Supreme Court may want to hear it to reconcile the issue, so that Circuit Court of Appeals and the lower courts are making decisions that are uniform across the nation. Well, another part of what tax practitioners do is research, tax research. It's a specialized type of legal research, and unfortunately, unless you go to like a Masters of Tax program, you're not really going to have the expertise of tax research that you need out of this course or the advanced course. But at least I can give you some basics. So you have a tax issue that your client needs researched. The tax law is such a vast area, you're not going to know a lot of the answers right off the top of your head because you haven't dealt with them. So you have to do this research. And so where are you going to go for this research? Well, tax law sources are broken down into two areas. Primary authorities, these are the official sources of tax law. They include statutory sources, that is the Internal Revenue Code. Not very helpful, to be quite honest with you. The Internal Revenue Code is fairly vague when it comes to applying a particular section of the Internal Revenue Code to your client's situation. The next primary authority is judicial sources. We just talked about the courts. The courts make decisions on how to apply the tax law. And so these court cases are primary authority that you can use in favor of your client. The Internal Revenue Service is the administrative arm of the government, and what Congress does is they write the Internal Revenue Code. It's vague, and what they do is they leave it up to the Internal Revenue Service to interpret the Internal Revenue Code. And so you have these administrative sources, these IRS pronouncements that are supposed to interpret the Internal Revenue Code. And so that's why you really don't go to the Internal Revenue Code, because it's so vague. You go to these interpretive sources, these pronouncements, which include Internal Revenue Code regulations, and there's others. But those are That's judicial sources and administrative sources are the main area of primary authority. Now, what if you're not familiar with a particular tax subject? Well, you might not want to go to primary authorities first because you probably don't know where to go in the first place. And so what you would do is you would go to secondary authorities, which generally consist of tax articles that might be in journals, in professional magazines, publications, things of that sort. Now, if you are a tax practitioner, probably what you would want to do, if you're doing a lot of this, is you would want to subscribe to a tax service, and this can be paper bound, but more and more it's electronic tax service. And what these do, it's an all-in-one system where you can go type in an issue, and it'll send you, if your search is correct, to the area of the tax law and give you several sources of authority as well as some interpretive background on a particular issue. So these electronic tax services are quite nice. And so here's just some examples of statutory authorities, Internal Revenue Code. Sometimes you might want to go to committee reports. If you've got a new statute, you might want to go to the committee reports. If it's not a highly litigated area, let's say it's a new statute or a new subsection of a section of the Internal Revenue Code, you might want to go to the committee reports to find out what Congress's intent was in passing this particular section. And you could use that argument in court or with the IRS in an appeal. Administrative authorities, you've got regulations, different types of regulations. The most important there are the final regulations. Revenue rulings are another type. Revenue procedures. Private letter rulings, if you're usually what you would do there is if you're considering a certain type of transaction that has tax ramifications and you want to make sure that you're applying the tax law correct on this transaction, you would want to get a private letter ruling before actually doing the transaction. Judicial authorities, again, starting from the general courts down at the bottom, tax court, court of federal claims, district court, and then you've got your Court of Appeals and your U.S. Supreme Court. I'm not too interested in the citation part of it. This is not a tax research class. If it were, we would get into citation and stuff like that. I just want you to kind of know what types of authorities are out there. Note here on page 11, Google not authoritative on tax matters. So, and when you do these tax papers, by the way, Google is not a tax authority. Although if you find certain authorities within Google, certainly you can cite those things. Here's some of the secondary tax authorities that you might use. The Tax Research Services, BNA, CCH is a real good one. RIA is even better. Newsletters, law reviews are a big one. Professional journals are a big one. So, you know, in excuse me, when you do your research paper, you would probably want to start out with some of these law reviews or professional journals to do some background reading. There's also some things that we'll talk about on the EOU website that you might be able to use. So they're asking, are these primary or secondary sources? Certainly Internal Revenue Code is a primary. Tax article in USA Today, not primary, it's secondary. Article on Supreme Court opinion, again secondary. Supreme Court opinion, though, is primary. RIA Federal Tax Coordinator, secondary. Treasury regulations, primary. So, U.S. Constitution, not that big of a, I mean, it's primary, but, and it's a statutory primary authority, but not very informative. It's just that we have the authority, the government has the authority to tax through the 16th Amendment. This kind of gives you an idea of the breakdown of the Internal Revenue Code, and I would encourage you to go and Google Internal Revenue Code and kind of look at, let's say, a section. The section I would view is Section 61, because we're going to be talking about what gross income means quite extensively. Note that, again, this is the Internal Revenue Code, and it's pretty vague language. Not too big on tax legislation process, so I wouldn't worry too much about that. Judicial sources, we've already talked about that pretty much, but their job is to interpret the Internal Revenue Code and settle disputes between the taxpayers and the IRS. They are the final arbiter if there's a dispute between a taxpayer and the IRS, and one of them, usually the taxpayer, files suit. And note the hierarchy we have in the judicial system. If the Supreme Court has ruled on a certain issue, then all courts must follow that issue. If a particular circuit court has decided on an issue but the Supreme Court hasn't, and you live within that circuit, you must follow that ruling as well. And then you've got your 3 court levels, as we talked about. And so this judicial doctrine of stare decisis is what we're talking about, meaning that a court will rule consistently with its previous rulings and the rulings of higher courts with appellate jurisdiction. Now the tax court, understand how the tax court works. They've got something like 17 or 19 judges. I spent, well, my highest degree is an LLM in taxation from Georgetown in DC, and I worked with one of the tax court judges on my final research paper in my LLM program. And so, and I also interviewed for a job with the tax court. So I know more than most people do about the tax court. Litigated there quite a bit too. Anyway, these tax judges travel around. Your case is not, if you're here in Oregon, your case is not going to be heard in DC. The judge is going to travel out to a federal court here in Oregon, or maybe even for Eastern Oregon, Boise, not sure, but somewhere where there's a federal courthouse, probably Portland. And they would hear the case out here. And let's say they hear the case, what they're going to do is they're going to look at how the Ninth Circuit has dealt with this issue. And so let's say they get through with our case, and let's say they go to the 11th Circuit. And it's on the same exact issue, except the 11th Circuit has made a decision that's exactly the opposite of the way the issue was decided in the 9th District. How do you think they're going to handle that? Well, there's this thing called the Golson Rule, and what it says is that they have to look at the prior decisions in that particular jurisdiction, appellate jurisdiction. So they may be deciding a decision out here on one day in the 9th Circuit using the 9th Circuit prior case, and then they go to Dallas and they have an 11th Circuit case that is completely opposite. Well, they have to use the Golden Rule and use the decision in the 11th Circuit case. So, they may have the same judge may be deciding the same issue two different ways because they have to follow the appropriate appellate jurisdiction. Kind of weird. U.S. Treasury, the Internal Revenue Service is part of the Treasury Department, and they interpret Internal Revenue Code. They have different types. They have final interpretations, regulations, temporary regulations, and proposed regulations. The most important one is the final regulations, because once they're made, unless there's some big change, that's their interpretation. Now, some of these are interpretive. Most of them are. Some are procedural. Some are legislative. It's not a big part of what you need to know, but just throwing it out there. Revenue rulings, less authoritative weight, but they provide a much more detailed interpretation of the code. And they give the example of these revenue rulings apply a specific fact situation to the code. Procedures, revenue procedures, as you can see, is dealing with procedures in administering the tax law. Again, fairly specific. Letter rulings, again, like we talked about, applied to a specific taxpayer. You want to get a private letter ruling in advance of a fairly sophisticated transaction that has tax consequences. And they give you some steps in this tax research. Now, understand that the type of research paper you're going to do is different than this, at least for the most part, especially when you're talking about communicating the results. It kind of fits your research paper, but not really. I mean, you still have to understand what the issues are with whatever you're writing on. You still have to locate relevant authorities, et cetera, et cetera. But tax research and writing, when you're a tax practitioner, is a different animal. You're doing more of a scholarly type of research, but some of this might come into play. And again, I'm not going to spend a lot of time on this. So anyway, I think that pretty much covers what I want to talk about in this chapter. Let's see. I think there's a couple more here. Let's talk about tax professional liabilities. Just understand that when you're a tax professional, what does that mean? Well, it means you're either a CPA that's authorized to practice before the IRS, you're an attorney practicing before the IRS, or you're this thing called an enrolled agent. And the main one I want to focus on is you're a tax practitioner, you're a CPA tax practitioner. You have certain rules and codes of conduct that you must follow, and these kind of overlap. So you've got your AICPA Code of Professional Conduct, you've got your AICP Statement of Standards for Tax Services, you've got your IRS Circular 230, and you've got your State Board of Accountancy statutes. Now, the first two apply only if you are, for the most part, a member of AICPA. I encourage you to do that, but it does cost some money. You know, if you don't follow these things and you're a member of AICPA, they can suspend you from AICPA. Now, and again, I'm not going to get into specifics because that's not the goal of this class. I mean, if you're really interested in this stuff, go get you a Master's of Taxation, or get a law degree and get an LLM in taxation. IRS Circular 230 follows pretty similarly to the statement on standards for tax services. Not exactly, but it's just rules and regulations that the IRS has out there. And then State Board of Accountancy statutes apply to tax practitioners as well as to other types of CPAs in working in other areas. And so what they do, these establish the professional standards for the practitioner, and they also talk about what happens when you fail to comply with the statutes. You can be admonished, you can be suspended for a certain period of time, or you can be barred from practicing at all. These aren't really important, but sometimes if you do something wrong, you give wrong advice to taxpayer client, you can be subject to civil penalties to the IRS. These are usually monetary, but they might impose some other things such as additional study or something like that on the practitioner. Criminal penalties, much less common. It's got to be something pretty blatant, like you're encouraging clients to commit a federal crime, tax crime. I had a client who was not a tax practitioner, but she was a tax preparer. And she was dealing apparently with a lot of low-income individuals, and these individuals would come in and say, well, I worked for such and such company, but they didn't give me a W-2 form. And so what she would do is she would make up a W-2 form for them. Not supposed to do that. So anyway, she was convicted of a felony, pled guilty to a felony of tax fraud, and spent 4 years in federal prison. Pretty sad. But anyway, you can get monetary penalties as well as incarceration. Not too concerned with that. All right, so that's chapter 2.